What's up? Welcome to More Than Mortgage. I'm Chad Anderson. That guy is Zach Jones. We are, what is this, 36, Zach? 35? We missed a week.
They're mid-30s, yeah.
Yeah, we missed a week because Zach was off gallivanting in the Rockies and taking long train rides off a cliff. But
yeah, it was
glad
my
to
fault.
see you back. Yeah,
it was my fault.
It was. How was the trip? It looked awesome.
It was excellent. Do I look better?
Oh,
Relaxed? Not really.
Yeah. Always.
Didn't
Yeah,
last
that mountain air did it for you. Yeah.
I got so stressed out with the flight changes on the way home. My vacation stress relief was out the window.
Are you still dealing with that? Is airlines still dealing with the flight stuff, or was that?
I don't even understand it. I don't ever fly American, and I woke up. I woke up and got ready to go to the airport, and I got a text at 4, 5, 6 o'clock in the morning saying, "Hey, guess what?
No, that was your first mistake. Yeah, that's on you. If you choose American or United,
I couldn't get there on my favored airline, so I have to go.
Southwest?
Who will take me? Huh?
Is your favorite Southwest?
No, I like Delta.
Oh yeah, Delta's the best. It's not even close. Delta's the best.
Is that what we're talking about today? Is airplanes?
Yeah, somehow we got off on that, but
because we don't want to talk about mortgage.
Delta's the best. No, what I really don't want to talk about is what interest rates are doing because there's so much misinformation out there. I think my daily email to the real estate agents on my list is just going to be rates went up this week. Stop talking about it.
Yeah.
It's almost a jinx, right? Like you talk about it and then rates go up. You don't talk about it. We have good days. So everybody just if you've ever been a sports fan, like you don't talk about the no-hitter in the 7th inning. Right. You just don't do it. You don't talk about any of this stuff. Like just stop. Stop. All right. So today we're going to talk about the Feds and the rates and maybe kind of what's coming down the path and the track. And we're recording this on August 7th. So we're about 6 weeks away from the Fed meeting that everybody's anticipating. What kind of a rate cut is there going to be? All those ins and outs. People thought, Zach, there was going to be an emergency Fed meeting because of what the global markets were doing over the weekend, which was totally off. Never happened. In fact, the markets immediately rallied on Tuesday. Had a huge loss Monday, huge gain Tuesday. Basically, it was a nothing burger over a 48-hour window. Right. But talk about what the Feds are trying to balance right now. And let's first actually step back. You're better at articulating some of this. The Fed's cutting rates. Like that's a thing. That's what everybody's waiting on. It can have a little bit of an impact on mortgage rates, but it doesn't mean your mortgage rate dropped when the Fed rate dropped. Right. So I'll let you kind of detail that for a second.
Well, so at least for the last 10 years of my career, I have been trying to coach everybody in my sphere of influence, clients, real estate agents, everybody, to disassociate any Fed rate increases or decreases from the mortgage market. And I usually just say, hey, listen, these are the Fed funds rate is a short-term lending operation and mortgage rates are long-term lending. So we're talking about overnight short-term lending versus long-term 30-year notes. Nobody ever stays in the mortgage for 30 years, or very few people do in our modern era, but that's the analogy. So I say they're both interest rates. So in that way, they're similar, but they are like 17 layers of cousins in between them because they react to the same market influences, but sometimes in completely opposite ways. So I've been after that and beaten that drum for the last 10 years of my career. And yet in the last 18 to 24 months, we are in a situation with this inflationary cycle where the Fed dropping rates actually is a huge flag to get that distant cousin over right here next to you. Are you ready to go down? I'm ready to go down. And it's like when the Fed decides that they're gonna make the rate cut, or they're gonna announce it, or it becomes baked into the system, mortgage rates are going to come down. And the reason that they're now, golly, I'm getting weird with this cousin thing. The reason they're now they're now
I'm the
kissing
one from
cousins.
Alabama, Zach.
Yeah, I'm coming in with the kissing cousins analogy here. So now they're kissing cousins because they're both going to go down at the same time. It's because they're both reacting to a high inflation cycle, which we haven't had in the United States in a very long time, not this high. So the Fed raised rates, what is it, 20 months ago now? Something like that? 18 months? Yeah. Raised rates. We were down really low. They raised rates sharply to try to cool down the economy. They're raising the price of money because people are spending too much money at a consumer level. And that was an effort to control inflation. It's about the only arrow that the Fed has in their quiver at this point with the debt load that we're carrying as a country. About the only thing that they can do is raise the price of that consumer debt. So when they do that, interest rates in the mortgage industry shoot up because the price of money, these things are going hand in hand. The price of money is higher on both the short term and the long term. So now we're in a situation where the Fed is trying to create this soft landing scenario. So we want to get barely into recession. We want to make it so hard on the American consumer that they stop spending money, which we haven't done. I mean, that's a weird thing that we can't stop spending money, even though we don't have it. But if we can kind of get into a little bit of a recession thing, then they can cut rates a little bit lower and do that strategically and progressively, keep inflation in check, bring the cost of things back down again. Interest rates are going to follow that trend in our current inflationary period. Now once we get balanced out, we're going to go back to this thing where interest rates have nothing to do with the Fed funds rate. But that's where we are right now, as they're mirroring each other. Is that a pretty good summary?
Yeah, no, it's perfect. And this isn't an offense to anyone, but this is very like confusing and uneducated territory for most people because we're not taught this stuff. Like when I got into the mortgage business, I didn't even know what the Fed funds rate was. You kind of learn it as you go. So how can you expect an everyday consumer who's just a school teacher or who is a server or who is a truck driver to understand what you're talking about? So we try to keep things simple, and it's very difficult a lot of times to really drill down and go deeper on it because it does get confusing. And also you look at it and you go, well, if we're trying to help you understand, sometimes we could either end up scaring you or creating false hope. Like it could be both ends of the spectrum, right? Because you're trying to figure things out yourself, and it's just kind of difficult how this how the whole system works. And it is crazy, right? Like think about that. When you wrap your mind around it, the government is literally making things more expensive for you, such as a home equity line of credit or your car loan. All of a sudden, car notes are 6, 7, 8, 9% versus 2 and 3% that they were before. They're making things more expensive. They're trying to tell you, stop spending your money. That's why also you could go put your money in a money market account or a CD and or a savings account. All of a sudden you can get 5-6% return on some of this stuff, depending on what you're putting in which bank. There were times where a CD would return less than 1%.
Right. Yeah.
So think about that. That's what the feds are literally trying to encourage saving, curb spending. That's what they're trying to do. And if they can do that and drive down inflation, that's where you'll have the opportunity again in this comparison to where mortgage rates would follow suit for the most part, or could follow suit. Yes.
And you got to, I just thought of this analogy. So, what we've been battling against is, consumers calling in, and Mary calls me and says, "Hey, I heard rates went up today." And that was because the Fed increased an interest rate. Or I heard rates went down today because the Fed cut the Fed funds rate.
Yeah.
And in the finance world, that's almost like saying, "Hey, I heard Walmart's prices went up." When you say the same thing, I heard rates went up.
Yeah.
There's so many items in Walmart and there are so many interest rates in the world that what you might more accurately say is I heard prices of athletic socks at Walmart went up today, but everything else is the same. And that's oftentimes kind of what happens in confusion about the Fed funds rate. It's just an interest rate. It drives a lot of things in the consumer world, but it doesn't drive everything in the world. So you got to kind of separate that out. And it's really weird, Chad. I mean, think about what a weird situation we've been in the United States. Inflation at historic highs, maybe not as bad as in the early 80s, late 70s, but super high. And yet people aren't slowing down spending of money.
Right.
So there's increased pressure. Everything is more expensive because of the rise in interest rate, and it almost pushes inflation a little bit higher just by the intrinsic cost of things. Because Jimmy's got a truck and he's got financing on that truck, and that truck is more expensive every month. My home equity loan is more expensive, so the things that I'm doing are more expensive, but I can't stop spending. So inflation has been particularly sticky because people won't put the brakes on their own personal expenditures. So we are, in August, looking at our first rate cut for the year when we should have already had 6.
That was what we were told, Zach. We were told
I
6.
know.
Okay, so
it didn't happen.
So let's do one more correlation here, and another tangent off of this topic is when you have this, people are trying to, or the feds are trying to curb spending. Are Americans going into more and more debt because credit card debt is at an all-time high?
Yep.
That is what's creating the CPI numbers to stay high. That is what is really battling inflation as people continue to spend. Do you think people are continuing to spend out of fun things like vacations, going to the movies, going to play putt-putt, going out to eat, going on a day trip to a nearby city or to the mountains or to the beach for a long weekend? Are people still spending in that way and they're continuing to just go further into debt, hoping one day it turns around? Or are they, and it's probably a balance of both, but I'm more curious which one is it lean more towards? Or is it the groceries, the utility bills, the homeowner's insurance, which is just a complete racket this year? Which side is it more leaning towards? Because all of those things I think are true. I don't think Americans have cut back on the fun things, as I call them. I think they're still doing that. Maybe not as crazy as before, but do you see it leaning one way or the other more?
Yeah, here's my take on it. So you remember in COVID, everybody's locked down. Nobody's going anywhere. Nobody's traveling, or they're traveling by car. They're not taking the big, expensive international vacations. Amazon is so good. DoorDash is so good. All of these delivery services are so good that you don't have to go anywhere anymore. And so people are spending that magic plastic fake money on their phones or on their laptops, and they're buying things that they never thought they were going to need before. We're building home gyms. We're getting a swimming pool in the backyard. Even though COVID, the shutdowns of the businesses, there were some people that were dramatically affected, but there was a lot, in a negative way, but there was a lot of personal wealth that was being built at that same time. And because we weren't going outside to do things or traveling other places to do things, there was a lot more money. And so we got I think I just watch, people's personal expenditures. People were spending a lot of money, and money was cheap to spend back then at 2.5% or 3.5% interest.
Yeah.
And so the interest rates go up, and it takes time to break a habit. So I think in the beginning, there was still a lot of fun spending, but as inflation pushes prices higher, the fun spending starts to get replaced with survival spending, and it's all going on the credit card, and the money's not flowing in like it was. And so the credit card debt is going up. And so now people are like, man, I don't know, we're not doing as much fun stuff anymore, but we're still spending as much money because eggs and milk and bread and cereal and, whatever costs so much more than it used to. Those prices haven't come down any. So they're still incurring additional debt on credit cards. We know that those numbers are at historic highs. So I think it's a blend. I think originally we were doing fund spending that was habitual from the COVID pandemic era. And now we're doing more survival spending, saying, wait a minute, where's it going to come from? We need to get rid of this debt and figure out how we're going to make our bills work and balance out and at least break even at the end of the month.
Well, and the last one, and that's what leads into this perfect segue, is that's why the jobs numbers are so stupid, is because I think now that people are in such debt, you got two choices, right? Well, really, you got three. You can either spend less, but the problem with that is you may be too far in debt for your current bills to battle inflation with your income, and then also try to pay down unnecessary debt that you ran up. So you could spend less, but I don't think that's like really the solution to the problem. So the second piece of that is you could refinance or sell your home, which we have seen. A third of all applications right now are refinances. Take cash out, reset to zero basically by using your equity. And that is an option. That is an option. The third is you get a second job. And what we have discovered in the economic data over the course of the year and even last year is that jobs were not being created at the rate that was being displayed. We know that because of all the revisions that constantly came out. The most drastic example is from Q4 of 2023, when you had 634,000 new jobs created. And after the revision, we saw, what was it, a month or two ago when it came out, it was in fact only 117,000 jobs came out. So they were off by 5.5x in that number. So people were getting second jobs. People were finding part-time work. People were doing anything they could to use that money to pay down some of their debt that they have, or just to live and get by because things have gone up so much.
And we saw those job numbers are very important because everybody wants to look at the glorious headlines, but there were months in there where we were losing 100,000 full-time jobs, and we were creating 140 part-time jobs. 140,000. And so those aren't equal. If you lose a full-time job in the job market, but you replace it with two part-time jobs, that doesn't mean anything to a full-time worker, because that full-time job may have been, a well-paying manufacturing job at $78,000 a year, and you created two jobs in fast food to replace it. It's not equal. And a lot of the full-time jobs that were created under the covers were actually government jobs, which is not an indicator of a healthy economy for in a capitalistic society. It's just an indicator of bloated government, and the government doesn't have any money to be hiring people. They're the worst consumer in America as far as debt load is concerned.
Do you think the government's on track for bankruptcy?
I don't even know how that works, man.
I don't either. I've always wondered that. How does a country go bankrupt? And I'm not smart enough to know if that's true or if that's just something, that's out there. But all I know is that we keep adding to the debt. So at some point you can't pay the bill. And I think that's what it is that the interest on the debt I'm butchering this, so I want to be careful, but it's, like 70% of the government's annual budget is just simply the interest that's being paid or something on the current debt.
Around there.
Yeah. So, I just look at it, I'm like, how does a country do bankruptcy? Because I don't even understand how that works.
I don't think we've had a state bankrupt, but I think that there's been some cities that have attempted to bankrupt, but then you don't hear anything else about it. It's like, okay, don't want to talk about that, but we're going to take care of it. Everything's going to be fine.
Nobody wants to bring that one up. Well, it'll just be interesting to see. Final question for you. This one can be short and quick. I don't want to put you on the spot, but I'm going to put you on the spot. 6 weeks from now, Fed's cut rates. Average conventional loan at the moment. This is from Mortgage News Daily. I'm looking it up. August 7th. Do your own research. 30 years, 6.58% is the national average.
Okay.
By the end of the year, where is that number?
let's just talk about yesterday at 6.43.
Yeah.
6.58. That's a day's difference.
Yep.
Everybody's still thinking that rates went down, but rates are climbing back up. So what do you think 6 weeks after the first Fed funds rate cut? I personally, if you're putting me on the spot, I'm going to say that that's a 50 basis point rate cut, which is a 0.5%, because I take the time to interpret bips for my customers, Chad. 0.5%. So maybe we get down. There's not going to be a direct correlation, but maybe we land at 6.2 to 6.3.
Okay.
And
which,
stay
by
steady
the way,
there.
Which, by the way, would be the lowest, at least in the last 12 months, if it gets there.
Yeah.
If it's there at the end of this year, that would be the lowest point, because it would be lower than last December.
Yeah.
So that would be the lowest point in 12 months.
Yeah.
And
the reason that I'm kind of leaning toward the 0.5% is that the data seems to support that. Now we're gonna see some more data come in, and I believe that the data probably strongly supports, and will stay in support of a 0.25% rate cut. But I also believe that there's going to be pressure coming from the White House to really make a big splash, because we seem to be in this election cycle, Chad, in the business of very big splashes, right? That's kind of what we're doing right now. The theme of the day is let's make everything a big thing. So if there's a substantive data-based 0.25% cut, I can't see the Fed not stretching that a little bit. If they overshoot it, then in my opinion, if the current administration has to suffer for that, they say, oh, well, we're trying, look at what we did for you. And if there's a new administration, then there's probably going to be some, we want to pass on as much bad stuff as we possibly can, look good, make them look bad. That's not a political statement. I think it's a statement about politics, but it's not a statement about party. I believe that that's the way the political system that seems to be the warring factions strategy right now, is make the other guy look bad.
Well, either way, I'll never call you weird. How about that?
Okay. Thank you for that.
All right.
Stay neutral here.
All right. That'll do it for us. I hope you learned a little bit of something there, or maybe not. Maybe we confused you more. But if we did, or if you just want to talk about this, drop a comment below. Like, subscribe, hit the bell. Zach Jones Loans right there. This Chad is real right there. Actually, I got to update that. It's not anymore. It's Mortgage Dad Chad. Right here. Sorry. YouTube, Instagram, Facebook. Check us out. All of our videos are there on the YouTube channel. Also, by the way, talking about rates and did rates go up or rates go down? There's a really good video on our channel talking about rates going up or down and what that actually means, and talking about the discount points and the par rate and how it all breaks down. Because believe it or not, every single day you could have a rate somewhere between 4.75% and 8.75%. The difference is, what does each rate cost along that ladder? And when we say rates go up or down, what we mean is that the cost of those rates either slides up or the cost slides down. The rates don't necessarily change. They're there every single day for your choosing, but the cost could go up or the cost could go down. So again, you should watch that video. It's a good one. All right. Have a great rest of the week. For Zach, I'm Chad. We'll catch you next week. See ya.
Thanks for joining us.